Guys, working investor here. As much as I hate to say this and look for shiny new objects, there's a new shiny object out there. It's called BLOX. It's the new kid on the blocks. This thing is kicking. It's kicking butt in every metric. Total return, price return. It's basically Bitcoin plus Ether, crypto industry companies, and it gives you weekly income. And let me show you how it's kicking everybody, all the competition to the ground. Let me show you. Now, bear in mind, this fund came out around June 16, June 17. So we need to look relative to June 16, 17. And let's go ahead and compare this BLOX, which is a cryptocurrency correlated asset. And you want to compare it to MSTY, the big boys in the block. You want to compare it to BTCI, which is from Neos. Compare it to Bitcoin as a benchmark, or compare it to LFGY from YieldMax. And let's see how they perform total return month over month. Again, it's a very short timeline, but look how this thing is killing it. And compared to its competition. BLOX, 24.63% total return, just about a month. MSTY, 10.15%, more than double, 2.5 almost MSTY, right? MSTR, 12.8%, right? BTCI, 10.99%. BTC, 12.81%. LFGY, 12.92%. So Bitcoin is up month over month, almost 13%. This thing is up 24.63%. And now this thing is not just paying you out, dividends like a machine every single week on Mondays, may I add. This thing also gives you great price appreciation. Let me show you the price appreciation. Let's change metrics. Let's go from total return. Let's go to price return, and let's make sure we have the month correct. And look at this. From a price return standpoint, this thing in 1 month returned 22% compared to MSTY, not even 4% in price return. MSTR gave you 12.8%. BTCI gave you 8.41%. Bitcoin gave you 12.81%. Well, it doesn't give dividends, so it's the same. LFGY gave you 6.42%. Kudos to those who have price appreciation, but this thing is giving you 22% price return. It still gave you some dividends as well. I guess 2% was the dividends. But this thing is a beast. Let me explain to you how this thing works. Now, I feel, in my opinion, there's two things you need to do if you really want to understand this fund. You need to read the prospectus cover to cover a couple times to really, understand what's going on with this fund. Secondly, I feel like that by itself, you have to also add this interview that Income Architect did with the investors, with the fund managers, with Jay Pristicelli and David, and you'll understand the context of what the prospectus says and how the fund works, the underlying of the fund. Together, I feel like you get a much clearer picture, in my opinion, how this fund works. So let's start diving into this a little bit. I'm not going to read everything because you guys could read, but I'll just, basically just go through some of the highlights. So basically it gives you exposure, I guess, like not really direct, not really spot. You have to read through everything, but it gives you exposure some way, shape, or form through Bitcoin and Ether, right? Another portion of the portfolio is the crypto industry companies like crypto miners. We'll look at some of the holdings. You'll have an idea of examples. And then there's also, and they give you also weekly income on top of that because they do options overlay on top of this. So let's keep looking at some more of these highlights. So you can see it came out 6/16/2025. This thing is brand spanking new, literally a little bit over a month old. The expense ratio, it's 1.03% for an actively managed fund. And here you can see the dividend payouts. They're paying out every single Monday, not Friday, like a lot of these funds do. Not that it makes a big difference for me, but some people like to have different days of the week paid. And you can see that they're consistent, 14 cents, 14 cents, 15 cents. Again, as you guys know, it's pretty new, but let's look at more of the sauce because the strategy is very important. So you can see the top 10 holdings is iShares, Ethereum Trust, Coinbase, Galaxy Digital, Robinhood, Riot Platforms, and Mara Holdings are both miners of Bitcoin. Hut 8, NVIDIA, MicroStrategy, and then Taiwan Semiconductor Manufacturing. And if you want to go ahead and nerd out, you could see here like all the holdings. and you can see some of their call. I mean, let's get it. We'll get into the biggest thing is the option strategy that I was looking into. But we'll look into some of these strategies a little later. But here you see all these options that's going on over here. Now, since we're talking about the holdings, listening to the interview, it sounds like they're very nimble. Like they could basically move in and out of different companies pretty quickly. Like a lot of funds, they have different rules. Like, they only reconstitute, or rebalance monthly or reconstitute quarterly, or some of them rebalance. Some of them could reconstitute more often, but they're pretty nimble. They don't have to it sounds like they can get in and out of companies a little faster. What I understood from the interview, again, nothing here is financial, tax, legal advice, or any sort of advice. Please see all my disclaimers. But just what I've heard from the interview. Here you can see an overview of the fund on the fact sheet. I'll give you a second look at it. Now, this is a cool trick that I look at when I look at prospectus. When it comes to the objective, right? So investment objective, you'll see some funds say that the number one goal is income, and then the secondary goal is capital appreciation, NAV appreciation, however you want to term it. This fund, I think, is vice versa. Look at this. The Nicholas Company primarily seeks investment objective to seek capital appreciation. The fund's secondary investment objective is to seek current income. So the number one above all O's is to have NAV appreciation. That's what I like about this fund. And based on the interview that I heard from the managers, it sounds like the dividends, you're not giving up too much dividends because they're trying to get somewhere between 30 to 40%. That's what they said in the interview. Of course, there's no promise anywhere, but they said that's what they target, because that's, competition demands that. But that's what they're kind of targeting. If you want to take a look at the income, I could show you. For example, right now, BLOX is trading at $23.61. I made 3 payments, 14 cents, 14 cents, and 15 cents. These are weekly payments. Let's just say 14 cents will go on the lower payment amount. So you take 0.14 multiplied by 52 weeks of the year, that's $7.28, divided by 23.61. So let's put in 23.61, and then multiply that by 100. So that's about almost 31%. So a fund that's targeting to give you somewhere between 30 to 40%, even if you want to say 30%, that's their target of dividend distribution. And that's their secondary objective. The number one objective is growth. That's actually really appealing to me. Now, if you look at the prospectus, look at the pages when I talk about the option strategies. This is what I did not understand, and only by listening to the interview it made me understand better. So it's kind of general and broad. It doesn't really tell you exactly the strategy that they're using. But on the interview, they mentioned the lightning bolt strategy, which is basically put credit spreads, hold the underlying, or at least have exposure to the underlying by some way, shape, or form. But if you look at the objective options overlay in part 3, in page number 3 over here, you see the fund seeks to generate income from engaging in the option strategies, primarily using options contracts on some or all of its underlying securities. In particular, the fund will receive income in the form of premium when it sells options. By selling options, the fund will earn premium from buyers who pay for the right to buy or sell the underlying asset at a predetermined price. I mean, we can go into, but it doesn't really give you exactly the blueprint. But if you look at this sentence over here, depending on the advisor's outlook, the advisor will select one option strategy or a combination of option strategies that it believes will best provide the fund with current income, while generally also attempting to capture some upside appreciation. So they're looking for some upside appreciation. Let's go to this one. Additionally, the advisor considers the performance of the underlying securities. In some instances, the aim is to generate additional gains if the underlying security increases in value, while in other cases, the aim is to limit losses if the underlying security decreases in value. Now, if you want to look at the actual option strategies they have covered in the prospectus, you see they have a whole myriad of strategies. They have covered calls, credit spreads, I guess that could be called credit spreads or put credit spreads, diagonal call spreads, there's cash secure put selling, calendar spreads, callers, etc. What I understand is that they're, maybe they opened up all these possibilities of strategies that they could deploy, because it's easier to have it in the front end than have it added in the back end and in the end. So basically that's where they talk about the lightning strategy. Let me give you an example of a lightning strategy. So let's say you own 100 shares of Hood, right? So, and Hood's price is $108.43. Let's say you want to generate some income and you're very bullish on Hood and you want to capture, you do not want to cap your upside potential. You want to make income without capturing your upside potential. You can go ahead and sell a put credit spread. So you can, which is called a defined risk strategy. You can go to trade options. Let's say we go, again, I'm not telling you to do this, but just for example, let's say you go to August 22nd, you could do sell put. You can just go, let's say you think that Hood's going to be above $90 for whatever reason, right? I'm just picking it arbitrarily, right? It happens to be a 0.16 delta, which is a full standard deviation, which is statistically significant. So you do sell put, and let's go buy put. Let's go $5 down, $5 wide. Right, so this is called a put credit spread. You see how Robinhood has a good way of just explaining to you. This is called a put credit spread because you're getting a net credit, and you could see here a nice picture that as long as so you're going to make $83 from this trade of generation of income in a few weeks, right? As long as Robinhood is above $90 and Robinhood is trading at 108, so Robinhood can go unlimited to the upside. Who cares? See, unlimited to the upside. This going up will not affect the strategy. You'll actually get you'll achieve max profit of the $83. But if Robinhood goes down, it's not a big deal as long as it doesn't go down below, you're not challenged below the $90. But even if it does blow past $90, your maximum loss is only $417, not infinite maximum loss. Why 417? Because it's a $5 wide contract, and you got multiply by 100, so you pay, so it's $500 on risk at the table. But even though you're risking 500 buckaroos, you are getting $83 in credit. So the remaining is $417. That's how much you're risking total. So it's a defined risk strategy. And what I understood was there's another layer. What they do is there's three components. There's the let me show you. So you see here, there's the equity portfolio, the crypto portfolio, and then there's then there's basically part three, which is the option overlay. So what I've understood was when it comes to the equity portfolio, that's the part what I learned from the interview where they do put credit spreads. They have no capped upside on the equity, like the stocks, like Mara, Riot, Hood, etc., whatever they're trading in and out of. And then on the crypto portfolio, where they have exposure to Ethereum and to Bitcoin, whichever way they do it, I'm not sure if it's exactly spot price or I think they said it's not spot price. There they do covered calls, so there they cap some of the upside. So basically they're effectively making an iron condor on the sector, not really an iron condor, but they're doing an iron condor on the sector. So basically, let me show you a visual of that. So an iron condor is basically a defined risk trade where you have a put credit spread on one side and a call credit spread on the other side. So you see in this scenario, you're receiving $83, right? But if you go back a little bit and then you go to sell call, and we're doing the same expiration August 22nd. Remember, Hood is trading at 108. Let's just go up to like 130. Let's say we're betting it's not going to go that high. Let's go to 140. Give it more room to grow. So let's say you're going to do sell call 140, and you're going to buy a call 145. So now it says here, you see where it says nicely short iron condor. It's a short iron condor because you're being, So basically, you see here, now you're receiving $140 worth of net credit, and so now you're having double the premium. And obviously, as long as Robinhood stays in this range, right? You're fine. But if it blows past the put side, you're challenged on the put side. But you're not. But you can lose in both directions. If your puts get challenged, your calls are fine. If it goes up, and your calls are challenged, your puts are fine. So you're getting double the premium. You're putting risk on both sides, but you can't. You know what I mean. But you can only lose on one of the direction or the other. You have to manage it. You know what I mean. So there, I feel like it sounds like an iron condor, but not really an iron condor, because the iron condor is a single equity, a single underlying, same expiration. You know what I mean? Call credit spread, put credit spread. And you're kind of putting this delta against this delta, so you're basically neutral. You feel like it's going to stay within a range. This is more like an iron condor ish, like on the sector, on the crypto blockchain sector. But there could be variables in different. You know what I mean? I don't want to complicate it too much, but that's how I look at it as an option trader. It's more like a kind of like an iron condor on the same sector, but basically. It's kind of from option standpoint, you're neutral, but you're overall long because on the equity side, if they go up, you're going to get unlimited capped up. You're not getting any capped upside on the equity side. You may get capped down on Bitcoin, Ethereum. So it's kind of like an interesting type of strategy, And if you listen to the interview, David said that basically like they don't actually pay out everything. They actually, if they pay out a certain amount, they hit the 30 to 40%. The remaining, they actually can use it to rebalance positions. When there's a pullback and things are down, they can go ahead and rebalance for you. They're really focusing on that NAV. They want to make sure you have NAV appreciation. Something interesting for my tax nerds out there, and again, I'm not a tax advisor, but look at Form 19, I think it's called 19A. So when you go on their website, you see here where it says supplemental tax, you pull that out. And now you can see here it's called BLOX 19A notice. And let's see if I can open that up over here. Yeah, let's look at the most contemporary one, 7/14/2025. So 7/14/2025, there's something called ROC, which is return on capital. So return on capital, again, speak to your advisor, but I think that's basically you don't get it's not considered taxable because you feel like it's like you're getting your money back. So you can see here that current distribution, 12.75 cents. That's considered return. Of the 14 cents, 12.75 cents was considered return on capital. So 86% was return on capital. Cumulatively, so far, 67% was return on capital. So you want to know which component of your income that you're getting is going to be considered ordinary income, where you get the most taxed. The least favorable tax treatment if this is not in a tax sheltered account. But you can see that 67% was ROC. So again, we have to see how the year pans out. But that's something interesting to look into when you get your distribution if you want to nerd out and have an idea of what your tax ramification is going to be. That's something cool that I noticed. As you can see, I have a little position here. I opened up a $2,000 position. I'm up pretty much like $75 on it already. It's just in a few days. It's still 100% margin maintenance because I guess it's just about a month. It should probably drop sometime next week. I'm already getting a dividend for my $2,000. It's a weekly dividend, so that's pretty cool. And look at the AUM. Wow. Because I remember last time here it says AUM 9 million assets under management. I remember looking at it just a few days ago and it was like I think it was 2 million or 4 million, but I don't think it was more than 4 million. And this thing like at least either quadrupled or doubled like in a few days. This thing is a beast and it's popping off the charts, and there's a reason for it. They're trying to give you good dividends and they're trying not to cap your upside, and this is like really cool. Again, not financial advice, something that I'm excited about, but I'm opening up a very small position as you see from my portfolio. It's about just under 1%. I may bump it up to about 1%. If there's a pullback in crypto, I'll probably add a little more possibly. Because I don't have to worry about capped upside, whipsaw kind of nonsense that you get with a lot of other stuff. Will they always do this strategy? I don't know, but that's what they said in an interview, that's their agenda, that they don't want to cap your upside too much. Anyways, let me know what you guys think. This is the Work Investor over now. I hope you guys have a wonderful trading week. Be well.